Volatility coming back down again. That allows people to leverage up a little bit more. I've been trying to figure out this morning what the driver of this move is today. Maybe that's it. What are your thoughts on what the drivers are right now?
Yeah, good morning. Nice to see you. I mean, it's really amazing to wake up to record highs every day. It's been a long time since we've seen something like this. I think what's driving this is first of all, what we really understood at the end of last week, which the stimulus, which we all had thought would maybe be whittled down to about $1 trillion or $1.1 trillion, is really more likely to come in at 1.6 or 1.7, even under reconciliation where not everything meets the requirements. So the stimulus is coming in much larger than the market had really priced in before. And then the other thing is that the ramping of vaccines in the U.S. matters, and it matters for growth, because it matters whether we can really get back to something that looks like a normal economy in the summer or not. And we've just had several days of 2 million plus vaccines here. We're on our way to 3 million, I think, by the time J&J comes to the market in 4 weeks' time. So that narrative really is staying pretty tight. And then, of course, earnings. Earnings have increased 10% just as the quarter has rolled on and the season has rolled on. That's pretty extraordinary. We're now up for the quarter, Q4 over Q4. As you know, that was not expected. We thought we'd be down 9%. Mm-hmm. So, all these things are rolling in kind of better than expected. Even though there was anticipation of it, the results are actually better than expected.
So, in your modeling, what's the level on the 10-year that's going to start to lower the equity risk premium and then sort of force money to come out of U.S. assets?
Yeah, look, that's it. I mean, the first thing, of course, is that the U.S. Treasury is much more attractive than what you can have globally regardless, but that's always been the case. I think it's not so much the magic level. We always talk about what's this magic level. It's not so much the level itself as the speed with which we get there. And I think to the extent that we can build in 7 to 10 basis points monthly as a gentle rise, I think that yields will be fine, even if they get to 1.7 or 2%. I think if it's more spiky and faster, then that number will be lower, and it could be as low as 1.5 to 1.7. It's not far away from here. We've had an enormous move in the last week or so. So it's something to keep an eye on, and we are concerned about those longer duration assets with yields moving higher. You're not going to be able to avoid that for long.
Yeah, Alex, I guess one way of looking at this, though, is that rising yields are a confirmation that the recovery is on track. Like, in some ways, this is a positive reinforcement of the idea that we're going to have a much better half in the second half of this year, and things are going to look relatively good. Alicia, isn't that kind of, or Alex, isn't that kind of part of this trade?
Yeah. Well, yeah, but I was going to say, and that's what I was making the point with Alicia, like earnings have to rise faster to offset the rise in yields. So it really depends, then, I think, on what earnings are actually priced in at the moment, that is going to be the turning point.
Yeah, look, I agree. I think we're still low on earnings for 2021 because if you think about it, what's really come out of the system is cost, and operating margins are looking better than expected. And as some of the non-earners come back online with revenue streams, you're going to see an enormous bump in earnings simply because of the leverage on the operating side. So I think that story is not done yet. It's clear that we're going to have something of a boom in the second half of the year. At some point, there will be a collision with yields, but not yet. And I just want to point out that this is a remarkably broad rally. Technicals really matter in this market, in some ways more so than fundamentals. We saw that last year as well. 91% of the S&P is trading above the respective 200-day moving averages, as is 92% of the Russell 2000. So why is that important? It's important because it means everything's working. It's a broad rally. It's not dependent on one sector. Broad rallies tend not to be tops.
Just coming back to the issue of tech, which we were alluding to just a moment ago. Alicia, the earnings were good from the tech sector. Why do I not want to own a sector that is delivering right now? I guess if yields go higher, you're not going sort of to this discounting to infinity arguments around tech, but you're actually going to a more solid earnings narrative around that sector.
That's right. So in 2021, earnings will take over from the multiple expansion. I think you want to go a little bit down on the cap scale here. Small caps outperform large caps for about 3 years coming out of a downturn. So we're sort of in the middle of that. And you can see the performance of the small caps since the November election has really been very strong. That's going to continue. I think you have to be in tech simply because of the earnings power and the digitization of the economy, which is happening much faster than would have otherwise because of the pandemic. That will continue. That trajectory will continue, unlike some other trajectories. But go smaller down on the cap scale for that to capture some of the value there. I think some of the larger ones are the ones, and actually the top 5 or 6, which are the top market cap of the S&P. I think those are the ones that you might have some problem with on the multiple side as yields move higher.
Hey, Alicia, do you like oil? Because year to date, it's the best performing sector in the S&P, up over 16%. We're now Brent at 60. What do you think?
Yeah, look, I think there's a lot baked into oil. I think one of the tricky things about investing in the energy sector is that in many ways the investor base has dried up. So I actually think the energy sector is going to be very strong this year. Almost because of that, because you have many, many investors who simply will not invest in the energy sector. And frankly, when energy is only 2.5% of the S&P, there's not a lot of pain there. But now the pain trade is higher, and there may be some forced buying as a result of that, because if energy goes from 2.5% of the S&P to 4 or 5% and continues to be the best performing sector, you're going to see some forced buying here. So in many ways, energy is the underdog simply because the investors are drying up, and of course the administration is going to regulate. In some ways, that's your best bet right now because of those things.
What about the banks? Like, where do we go there? The curve is steepening up. Does it continue to steepen up? How much is left in that trade for the financials?
So I think there is a lot left in financials. What's really interesting, if you look at the financial sector, just on trading, the financial sector finally re-achieved its old high from 2007 just last week. Let me say that again. It's been 14 years for the financial sector out in the wilderness. And moves like that tend to gain steam when they've taken out an old high that was more than a decade in the past. So I think financials move here. Obviously, the capital market sectors we think will be stronger. So we look for those kinds of names given the interest in trading and, of course, capital raising and all the other activities that we've talked about on these shows about what's happening in the last 12 months because of the liquidity. Financials will move higher. Technically, they look terrific. And remember, in many ways, technicals right now outweigh some fundamentals. But, of course, the yield curve matters as well, and we're going steeper.